So now we're going to look at section LO 6-2, which is looking at absorption costing, specifically looking at the income statement. So to examine the difference between absorption costing and variable costing, we'll use the example from Sunnyvale Manufacturing. So Sunnyvale Manufacturing, they produce high quality cooking utensils that are packaged in sets. And each set is sold at a fixed price of $30 a set. To ensure quality, the company operates a modern facility equipped with advanced technologies. And the company employs skilled workers who manufacture all products to high standards. So Sunnyvale's annual production data and product costs are shown here. And this information also is available for you on page 194 of the text and I should say, since will also be going out on YouTube, the text I'm using is the Managerial Accounting Principles version 4.0. It's published by AME Learning. So we see the information listed here on the screen, and we see that the company also has included non-manufacturing costs such as head office rent and sales department salaries. And so we're going to assume that now that Sunnyvale Manufacturing manufactured and sold 15,000 units in 2024, and that they had no beginning inventory. So this is what they had for the year. And so if Sunnyvale chooses to use the absorption costing approach, the product cost would include all of the manufacturing costs. And of course, we see some of the non-manufacturing costs there as well, which we'll see how this gets broken down. So since the absorption approach conforms with the generally accepted accounting principles, the cost information can be used to prepare a formal income statement. And so for the year of 2024, which is the year that we're looking at, Sunnyvale generated revenue of $450,000. And so that would be $30 a unit times 15,000 units that they sell. So we see that listed there under the sales revenue. Now, the cost of goods sold includes direct materials, direct labor, and all of the manufacturing overhead. So we see there that it said that they sold all of that, so they had no beginning inventory. We have all of the costs, with it, 330,000. They sold all of that, so they didn't have any ending inventory, and so we have that now. And it should be 330,000. There's actually a typo. The chart in the book on page 195 for the income statement actually is correct. Here on the PowerPoint, there's a mistake. So it should be 330,000. But regardless of that, the cost of goods, so the gross profit, regardless, is still 120,000 is what it should have been. So we know that we deduct that, then we come out with a gross profit of 120,000. And then after the non-manufacturing or operating expenses, the operating expenses then further get subtracted. And so that leaves the income from operations or the net income of 83,005. So then they can go ahead after the gross profit, then we can subtract all of our other operating expenses. And so we have rent and then salaries. So that's 36,005. And so then we come out with the total from operations of 83,500. Now, true or false? Which of the following statements about it is true? It is so. Is it that the cost of goods sold is calculated as the cost of goods manufactured minus our ending inventory? Is it that the income from operations is calculated as the gross profit plus the total operating expenses? Is it that the cost of goods sold is calculated as the beginning inventory plus the cost of goods manufactured minus the ending inventory or all the statements are true. And it is that C, that the cost of goods sold is calculated as the beginning inventory plus the cost of goods that were manufactured minus whatever they had, the ending that's going to go into the next period.